A beautiful rags to riches story from shoeless at 5 in rural Mexico to 31 acquisitions in 3.5 years. Luis Reyes is building Spain's fire safety market leader with an AI-first playbook and 8 million and more in EBITDA. Thanks a lot for coming to the broadcast, Luis.
Yeah, of course, Mike. Happy to be here, and thanks for the invitation to talk about.
Let's start with maybe 2 to 3 minute version of your path from your childhood to SaaS to Spain, and what have you done so far?
Yeah, sure. So as you mentioned, I was born in Mexico, really underprivileged economically, to not say poor. It's a lot of people in Mexico, so I'm not the only one. Fortunately, I had some parents that instill education in me, and also fortunately, I have some teachers that guide me to computer science, which happens to be at the moment I graduated the place to be if you wanted to earn some money. So no big foresight. It was mostly, again, people that care about me leading me there, and it was the right place to be in the early or mid 2000s. Very high pay jobs for being probably an okay software developer, and that led me to the US, where I developed most of my professional career, starting in SaaS, building software, then having my own startup, having a modest exit, and then I decided to kind of doing the opposite of what most people do, that they go from corporate to entrepreneur. I went from entrepreneurship to corporate. I had the opportunity and the privilege to be, accepted at great places such as Google, Riot Games in the Silicon Valley, and then McKinsey. I was there for more than 4 years, doing a lot of really hands-on consulting, despite of being on the generalist track. But I did things that excited me, which more about restructuring, integration, value creation, and got to see what happens when great businesses merge or divest assets. So it was a great time for learning. And then I transitioned into doing the same type of job, but in Spain with Bain & Company. Was mostly an interesting opportunity personally, and for my wife and kids that have lived mostly in the US, to go to a Latin environment without going back to Latin America. And then being in Spain, we work for private equity, helping them in value creation plans. And it was clear to me that the opportunity to build a more hands-on approach to private equity was great opportunity for me personally, because I had some skills that I thought were helpful. And then for the marketing, which there's a bunch of middle market private equity firms doing mostly buyouts, and so really no consolidator of small businesses, not really player focus on roll-ups, and a bunch of opportunity, because the Spanish market is mostly fragmented in many industries. So it was a match of time, opportunity, and in my teams, because I'm not alone, right? My team's skills a good match, and so I decided to stay in Spain and build what right now is IVV, which we believe are building one of the best roll-up operators and investors in Europe. We're just beginning, but we have confidence that our path it's just the first of many buy and builds that are going to execute over the next years. So
okay, and the initial thesis for the current roll-up you're building, how did it all come together, and what about the team? How did you put this together?
Yeah, sure. So initially we started 3 partners. One of them was my teammate at Bain. So we hit it off. We did a bunch of projects together. So early on, we were talking about doing things together. And then he also had a childhood friend that was really close, and we, got together for beers or over the weekend and talked for years about what we wanted to build. And then, they had some years working together besides being friends. And I had with my partner now, Alvaro, a few years working together. And then at some point we decided it's the moment to do it. COVID was a catalyst to really make the decision doing this. And the particular, flavor of buy and build, which is SMEs in business services, turning them into middle market companies that can be interesting for big pan-European consolidators. I guess it's not a, the hardest thing is not to conceive of the idea because it's an obvious thing to do, maybe. The difficult part is to really commit yourself to do a bunch of hands-on work and deploying capital in really super tiny opportunities, sub 1 million EBITDA businesses, and without having the infrastructure. Right now, for us, it's easy. We can talk about it later, but now we have the infrastructure to do it at scale. But at the time, it was me and my partners without, a team for it. So we decided to do business services for things that, are obvious. The businesses are great, cash generating, recurrent revenue, barriers because of regulation. And then when you look at other markets, Northern Europe, the US, these businesses fetch like double-digit valuations and are one of the most sought after capital deployment opportunities, even without thinking of an exit. If you hold them, right, like you can continue deploying capital at, ROC rates that are ever higher, and you can continue doing that for a long time. So it was just a great opportunity. And then you have the list of all the different services from HVAC that everybody knows to, landscaping and whatnot. And then we decided on fire safety because for us it was the most interesting. And we have a few targets that we knew of that we could start with something already. And that's basically it, how we start.
Now, what about the capital, if you can share? Where were you all three financially? And what about the fundraising? And
Yeah, sure. Look, coming from startups also, and by the way, from startups in the mid 2000s, because right now everybody just prepares a deck and raises tens of millions. That wasn't my experience. It was more you build something useful, you validate that you have product market fit, and then you raise capital for it, right? And so I thought more about in that way than as a typical private equity manager. So the way we started is we really first invested our own money into validating the opportunity all up to the time that we have a few LOIs identified. And by that time, obviously, we needed some external capital. And really, we went with friends and family and through referrals. We raised a little bit of capital, less than 1 million. And that was enough to buy the first company, less than 500K EBITDA. But it was enough to have a proof of concept that, the business was as good as we said, and that we could do something with it. So we acquired it, and then we operated it for a few months as we refined the story. And then when we had something to show, not only a deck or career trajectory, but an actual business that we can say, look, this is what we said, this is what it's happening, and this is where we can take it if we have more capital. And it is just a matter of getting intros, and you know how things go, right? If you're doing this, it's easier than to raise by a PowerPoint deck. And so we just hit the road. A bunch of people help us, which we appreciate. And we managed to get in touch with family offices, mainly from the north of Europe, that are specialized in these kind of strategies. And they decided to support us.
Okay. And the initial deal flow, you said the first one you acquired, then you went and raised additional capital to move forward with a thesis. How did you build the deal flow?
Yeah, so for us, again, like even before having capital, we were sure that we were going to do it. I mean, we just didn't know where the sources of the capital, but we were working on the pipeline day one. Even if we made the first acquisition May 2022, since 2021, we hired with our own capital a few people doing outreach, all proprietary, right? Because these deals are super small for a broker. They're not interesting to generate them proactively. So we had to have our team working the phones, validating each one of the deals, visiting the companies. So by the time we actually acquired the first one, we already have like 20, 25 potential deals. And by the time we finalized the capital raising, we had hundreds of companies on the pipeline. Yeah.
And the typical seller, is it like a gentleman in 50s, 60s, or it's someone younger? And do you always acquire 100%, or there are some different structures you've implementing as well?
Yeah, sure. Look, the there is no typical seller now. In the beginning, yes, we were prioritizing owners on the verge of retirement with no succession because of obvious reasons, right? You're going to have better deals in terms of entry points in those with those characteristics. However, if you want to do something at scale, it's hard to focus only on those regions. And particularly in what we do, we like it because integration is a prerequisite to really get synergy. So that implies two things. If you already have a presence on a city, you need to keep acquiring because every acquisition, as long as obviously meets some requirements of quality, is going to be super accretive, and it's going to be more accretive than the last one because your infrastructure and your fixed costs are levered over a wider base. Your technicians can be more efficient. So you cannot restrict, once you're in a city and you want to do it at scale, you cannot restrict to only owners that are going to retire. So to your question, we have all type of owners, all ages. If they, the seller has or the potential seller has a great business and he's 40 years old, number one, that's pretty rare, but probably that person won't sell, right? So that's just because these businesses are so good. We had some of these successes, but the point is we target quality companies regardless of the owner's age. Yeah, and we acquire right now 100% because again, our specific type of roll-up requires deep integration, and it's very hard to do it when the owner of the business retains a percentage because that business in most cases basically disappears, right? Like you close warehouses, you integrate technicians. So it's hard for the owner to keep having a percentage even at the holding level and see his business, quote unquote, disappear, right? Most of the owners of these companies are not at that level of sophistication or understanding or even desire to keep joining a project where, their original business does not exist anymore.
You mentioned deep integration. Can you share what exactly you do post-acquisition? And is it always like, let's put it in this way, what have been some of the biggest challenges so far?
I mean, so to your question, we have the typical 100-day playbook where, the first 30 days, your mission is to understand, do no harm. The businesses, we know them pretty well. Most of these businesses operate the same, but the particularities of each one make it, those are the risky ones to touch. So the first 30 days, we do a transition of accounting and customer service. We provide some support, finance, but mostly getting to know the business and transferring contracts and whatnot, right? In the next 60 days, we do transition some of the day-to-day management responsibility to our operating manager. So the operating manager of the city that business is in, it takes control of the technicians, of the way that the warehouses are organized and whatnot. And then much later, after those 100 days, we start to see what improvements we can do to the operation, right? But again, first 100 days is just transition out to our structure. And challenges, our model, we also like it because we're learning the difficulties of integrating and scaling a service businesses. And every day there's new challenges. This is a people business, and obviously every person is different. Every organization has a different culture, but we're learning some patterns, and better yet, we're learning on how to handle those, right? And they go from the most mundane, but still really important, that if you're closing a warehouse where people have worked for 20 years and they have to move now to go to their work, just beyond the regulatory things, which there are some considerations. I mean, these people need to be okay with that change, which is for some of them a huge change, right? Some of them might even have moved houses to be close to their work, and so that you have to treat these things with consideration. And then you have the more, let's say, strategic and important things, which is when you are integrating customer service, there are some things that can break, right? Some of the companies do have an extremely high bar of customer service, solving problem like minutes after they're reported by the clients. It's hard to keep that level of service at scale. So we're investing in technology to really maintain that level of service that some, but not all of the businesses have, but it's a challenge, right? And we're not perfect. And when you're not perfect in handling customer complaints, especially in our business, you lose that customer and you can have higher churn. So there are a bunch of challenges, and this is part of our mode that we're learning how to handle it.
And what have you seen so far? You mentioned this being a people business. How do you find those talented local operators? What is the process there for you?
Yeah, sure. So let's distinguish between the field management and then the corporate management, right? For field management, typically, most of the acquisitions that we do, or all of the acquisitions, should have a capable operating manager to handle the technicians of that acquisition, right? So even most of these companies have 5, 10, 15 technicians, but they do have a leader. So that we acquire with these leaders come with the acquisitions. Now, some of these leaders do have potential to scale, and we can proudly say that 90% of our regional managers come from those acquisitions. Some of them have gone from managing 5 technicians to managing 50, 60 in a period of 1 year and a half. And that's also what makes us very proud to give these opportunities. Now, if in a region we don't find any of this, talent, which is rare, we go and hire somebody from competitors in the region. But that part, I can say that we're very successful at pulling leaders out of our acquisitions. Now, for the corporate layer, that's harder, right? Because these businesses, you're buying a bunch of businesses and trying to build a corporation or a big company out of it, and bringing people that have the expertise in the sector, but also have at least the ability to deal with a company that is information. It's pretty rare. So in that area, we're partnering with we're creating a talent organization inside IVV, but also partnering with, I want to say, executive recruiters, headhunters, however they like to be called, that really understand them and they know the type of talent that we're bringing, which is a mix of analytical power, hands-on work, experience in certain type of sectors, and also the ability of building a company and then leading it. And that's super hard, right? So we're always interviewing people, and our triad of general manager, COO, and CFO needs to be in place early in our platforms to have them focus on the day-to-day business while IVV builds the platform, right? But that's the hardest challenge, to find this triad of talent and managers.
Hey, a very quick pause from this episode, and if today's conversation resonated, it's probably because it highlights what a lot of people and a lot of investors miss. It's that very good, oftentimes even the best opportunities are operationally driven lower middle market deals, like buying a boring business, installing systems, and simply letting it compound. But here's the frustration I hear once in a while, and it goes something along those lines. The lower middle market is where the deals are, the good ones, but every fund wants 500 grand minimum and then locks me up for 10 years. And that is the simple reason why this episode is sponsored by CapitalPad. CapitalPad is a platform for deal-by-deal private equity investing in the lower middle market. You can review each opportunity, you can do your own diligence, and decide one deal at a time with minimums starting at $25,000. It's for accredited investors only, and they're extremely selective about what they put in front of you. So, if you've been waiting for a way in without the massive minimums and decade-long lockups, check it out at capitalpad.com. I'll also put the link in the show notes. And now, back to the show. Something you mentioned was maintaining the service with technology. The businesses you acquire, do they have this type of systems already in place, or this is your advantage as something you do post-acquisition? What have you seen so far, and what are the things you implement?
Yeah, so these businesses don't have it, right? Like let's talk about the base case. In the best case, they do have a financial and operating ERP, right? And that's the best of cases. And it's generally, SME focus ERP, but at least they have information of high quality that you can export and integrate into your system. That familiarized in dealing with a computer interface. But that's going to be 25%, to 30% of our acquisitions, right? That have the data and a system. But that system is pretty basic, right? Is to have accounting and to have control of the work orders and the invoicing. That's it. So for us, what I mean with scale is that as you group some of these SMEs, some of the problems that individually are minor, for example, a typical business of this sector might receive 30 calls per day, 50 calls per day. If you integrate 10 of these businesses in a city, you might receive 500. And because of the integration challenges, maybe you receive 1,000 calls per day. Now that becomes a call center. And these companies, initially, in just talking about call centers as an example, in these companies, they don't have a person dedicated to the phone, right? They have all the back office handling the calls as they're available. But if you receive 1,000 calls, now you have everybody, instead of doing their work, becoming a call center technician. That has an advantage, right? Which is you solve the customer problems, because if the accounting person answers the phone and it's a problem with scheduling the job, that person transfer the client to the scheduling person. But if you do it again at scale, that becomes a nightmare, and that basically nobody works except on answering the phone. So what we did is we created an AI system that is specialized for business services on understanding the customer request, the urgency of the request, and then it filters some of the calls to the person that can handle it. Some of the issues are solved, like send me my invoice. The system fetches the invoices and sends it directly, and then other calls are transferred directly to technicians. For example, real urgencies that in fire safety you have to handle. And so that way, instead of 1,000 calls to our team, we pass 20 calls, which are the critical ones that need to be handled. 500 we answer directly with the technology, and then the other 500 are created on a ticket and then assigned to a person to answer over a period of a week. That type of technology, we use standard LLMs and standard software, but really the value is on customizing for a very particular use case, which in business services, you have many of these workflows that are unique and that we are discovering as we go and putting it into our proprietary technology stack. And this is the case for many, many different layers. I just gave you the example of customer service as a representation of that, right?
But the AI agent, if we call it, did you build this product yourself, or you're using like a third party?
No, we're building it ourselves. Again, like on the back end, we're not building an LLM, right? We're not competing with ChatGPT, with OpenAI. We're using the APIs, depending Grok, Gemini, whatever we're going to use. But the actual workflows and the agent is ours, because we try, by the way, 15 different market call center AIs, and they're great at generic tasks. They're actually better than ours, right? At just answering to the customer and recording a message. That is not a challenge, and you can find much better products in the market. The problem is, how do you learn to differentiate a customer that is saying that he has an urgency and needs to talk to a person integrated with, by the way, not one ERP, because we're always integrating and buying companies. So even when 90% of our work is in one ERP, we might have at any point in time 7, 8 ERP, some of them without really an API. So how do you integrate a third-party system with 9 different ERPs and understand what an urgency means for us? If you build that on a third-party stack, which you might, you now put an uncertainty on your business model, which is, a system. By the way, most of these platforms don't have not even 1 year of existence. So you put your whole business on some of these players, and it doesn't make sense from a risk management perspective and also for a speed of iteration. And by the way, the cost of it is relatively low. We have our internal team, which is 2 people doing tech, 2 people doing AI, and then the cost of running the platform, which is in the hundreds of euros. So it's mostly on the opportunity cost, because obviously, as you're building that, these people could be building other type of tools, right?
But if you measure the before and after, how much more efficient you are, and I'm sure thanks to this system, you're not losing clients as you maybe what happened before. So how much more efficient you are?
Oh, way more efficient. We last year, which is the first year that we implemented this system, for example, just to talk about the back office functions, the core back office functions, and we reduced the size of the back office tasks on 25%. just in 1 year. And obviously that won't go 25% per year. Otherwise, no back office needed in 4 years. But that is the impact, and all that cash and all those margins are being invested in more important or more core capabilities than answering customer calls or sending invoices manually, right?
Now, sorry, as I don't know too much about this industry, but what about the sales cycle? I mean, like if someone is calling in, uh, how do you do some upsell and things like this? Because this with such a large portfolio, and you said like in one area having like 500 to 1,000 calls coming in per day, adding some additional services could make a huge difference. How do you solve this, or is this even a case?
The calls are, I would say, 70% service call and 30% are commercial calls. And if the calls are from big clients, by the way, these clients have the phone number of an account manager, so they shouldn't be calling the call center. But if they are, we redirect them to their account manager. So we do have, given the universality of our services, and in general, business services are universal, we have some very large accounts with hundreds of thousands or millions of euros in revenue. Those are handled by dedicated account managers. In the automation, there are more to support the account manager, but we won't automate sales calls for this type of customers, right? We have literally hundreds of thousands of customers that are 100, 200 euros a year. And for those, you do want to automate as much as possible. The easy budgets, right? Like they need standard service, standard maintenance contract, that can be automated pretty easily. For the upselling, though, and the cross-selling with our different type of services, you do need some touch with the customer, and that is provided by the technician or salespersons, depending on the size of the account. So far, we haven't gone to that level, but at some point, with the data and the agents specialized in sales, I can see a future where a customer calls and you know that that customer has only 50% of the potential, and then you might pitch them other things, but we are not at that level, and you want the AI to be much, much better at customer interaction, because otherwise it can become very annoying that you call for a service and then you end up being pitched something, right? So we are not at that point yet.
Where else have you used the AI in such a way? Okay, one being this call service customer support. Where else have you tried but maybe haven't succeeded? And what you can say is like what areas you could say that AI is maybe not the best.
Most of the also the difference, right now there is a trend of AI roll-ups in which, VC money, by the way, not PE money, it's coming for white collar services industries like accounting, where the actual service, it's administrative, like moving papers or information around, and the VC money is coming in to automate the COGS, let's say, or the core service. In our case, we like our industries precisely because they are not those type of industries, right? Like essential services, and think about water pipe maintenance. You won't have AI that fixes the water pipe. What you may have is an AI that in the future, right now that's not available, but in the future helps the technician to do their job better, that tells them exactly what they need to fix, where, and that issues the certificate later. But you might reduce, in the end, the limiting factor will be a person that needs to open a hatch, needs to get into a place, and needs to do some work with his hands. So you have limited potential to improve core profitability by reducing the time that it takes each job. However, by the buy and build, you can increase density and you can have that technician just do his job and not spend time on traffic. So this is where, the roll-up, the integration, the buy and build core thesis in essential services is about the density and about more customers per technician. Now, where you do have a bunch of opportunity are on all the tasks that are supporting that technician in the street. And this is scheduling of jobs, confirmation of jobs, sending of invoices, handling customer issues with their invoicing, changing their customer legal entity, sending a technician when they have a problem to a specific location. And so we have a map of all the different tasks, which ones are higher value and higher percentage of manual work, and we're prioritizing those. Now, to your question, where AI doesn't work as well, more than that, I would say is where we are more careful deploying that, and this is where a core part of the job is involved, because we don't want to miss out on a job or issue a certificate that is incorrect or sending a technician to a wrong location. So the closer you get to the technician and to the customer core job, this is where we're being way more careful. You can imagine that if a commercial call is answering correct, you might lose a customer. But if a customer has an emergency and you send the technician automatically to the wrong address, that might have consequences. So AI is not perfect. It has hallucinations, it has issues, and we're trying to mitigate the impact of those hallucinations and issues by nailing the technology as far as possible for the core job, if that makes sense.
One more very quick pause from the podcast. If you're listening this and you're thinking, well, I need a repeatable engine for deal flow, for fundraising, and for talent, for relationships, what you're doing is you're describing a newsletter. Because the smartest channel in 2026 is the one you control. That's why today's sponsor is Spacebar Studios. So if you're ready to launch, they'll honor your first 30 days free, so you can kickstart your growth risk-free. And here's the bold part. They guarantee a minimum of 10,000 subscribers in the first 90 days. No long-term lockups either. After the launch, it's just month to month, which means no unnecessary risk for you. So if you want compounding asset that builds trust the same way Luis is building IBV, you should consider maybe building a list. And again, spacebarstudios.co. I'll also put the link in the show notes. Again, spacebarstudios.co. Go check it out, what these guys have to offer. And now, back to the show. Now, Luis, it's hard to find a better person to ask about building deal flow. And in your case, you said like most of the deals have been in this size of 1 million EBITDA. So many folks listening might want to build a similar type of strong deal flow. So if you can go specific, like how does your deal sourcing look like when we take like week to week? Maybe you can share the channels or yeah, what are you using, what works, what doesn't work, and how have you done it so far?
Yeah, sure. Look, on the one hand, this is about volume in the entry of the pipeline, and then in the middle, some way of minimizing the amount of work that it takes to decide whether it's a good investment or not. But on the other hand, that no bad acquisitions pass to the end of the funnel, because that's actually what can kill these strategies of buy and builds, right? You start buying low quality revenue, low quality clients, and very quickly you can burn capital and your value proposition is gone. So on the entry of the funnel, on the one hand, there is no substitute, especially in these companies, to getting out there, right? So we do not automate calls, we do not automate sending of letters, we do not automate, a bunch of emails which I know a lot of people do, and actually that does damage relationships. So in this regard, we're pretty old school. We have people that go and visit the companies, and these owners are actually very surprised. And sometimes they show you a stack of letters from search funds or other type of investors that just basically flood the market with letters. And so that approach we don't take. There's zero automation, and there's a lot of visits, customers. Obviously, we do have our own tools and third-party tools to really prioritize which companies to see. And we prioritize them based on our own internal metrics. So density of clients, where we have already a sizable operation, and then based on the characteristics of the business, and our M&A team receives instructions of, we are prioritizing zone X in Spain. And that is completely, let's say, automated, but the outreach is about having people and having people visit. Now, as we grow, we have unfair advantages compared to other competitors, because we become an industrial players, and our operational managers have contacts all over Spain, and we start to receive a bunch of inbound deals because of the people that have sold companies to us speak well about the what we do. Now, on the other hand, on the evaluation and investment committee, that there we do automate a bunch of things, and we have more than 100 metrics that are not only financial, are operational, compliance, quality of the business, to basically not be subjective when we decide if we acquire a company or not. And that we do have a bunch of automations and make the decision pretty objective. And every investment committee we review 5, 6, 7 companies a week, and the technology that we have tells us whether it's a good deal or not, and then it's just about confirming that assessment. But yeah, on the opening of the funnel and creating deal flow, we actually find an advantage of not automated and not being AI or technology driven.
And when it comes to your take on buying 5, maybe 1 million EBITDA businesses versus one company which is doing 5 million in EBITDA, what is your take on this? Because you have so much data.
Number one, we prioritize verticals where there are no 5 million EBITDA players, right? So the one that we're doing today, there was just none. So it wasn't even a matter of prioritization. And actually for us, that's part of our protective market structure, because you know all the verticals that we target are really high value and sought after by pan-European players that have hundreds of millions more than we are. So capital is not our advantage. Why they don't come and do what we're doing? Because the companies are small. Precisely, that's our mode. And then once you take the companies to 10 million in EBITDA, as low as 10 million, you start getting the calls from all pan-European players, because for them, it's better to buy your company at twice the multiple than doing the 30 acquisitions themselves. So that's the short answer. Now, again, if you go into a sector and there are a bunch of 5 million EBITDA companies, I honestly think that at this stage, I mean, ask me again in 5, 10 years, but at this stage, I mean, you would need to really be aggressive on your assumptions to beat against the other pan-European consolidators, because they're going to pay 9, 10, 11, 12 times for things. And if we started that way, I mean, we're already in an uphill battle to really generate value out of that. So we just don't, basically.
Now again, trying to get some of the lessons from you, as you have so much data. Now, if you look at the deals you've done, and if we take the ones which maybe haven't go that well, what were the things you maybe missed? And when doing the acquisition, you saw things became true pretty much. Do you know what I mean? The question?
Yeah, sure. I mean, to be honest, I mean, every deal has to have some things that we could have done better, but fortunately, so far, no deal has blown up. And I mean, at some point, maybe I wonder if that means that we're not being that aggressive. But fortunately, no deal has blown up. But every part of our mode, again, in thinking of IBB in the future beyond what we're doing, part of that is that these learnings get codified on the one hand and everything, right? On the contracts that we do, in the way we evaluate deals, in the way we structure our transition, our 100-day plan, in the way our tools are structured to receive customer calls. So, I mean, I could talk about all kind of things going wrong, from customer concentration being looked at the individual customer level, but then when you analyze groups or related companies, related concentration is higher. When you look at churn on a yearly basis, strictly January to December, but you should be looking 3 months ahead, because most of these companies have backlog, and that actually gives you positive surprises where you're assuming these companies have 10% churn, then they might have 7% or the opposite. But so far, I wouldn't point at anything that was fatal or that make us lose money on any deal. But we do, by the way, this is also to say that we take a long time closing deals. So we do more than 30 acquisitions, but at any week, as I told you, we see 5 or 6 companies, and our average closing time for deals is in the months, right? So we're not the type of buyer that you show a company, we give you an LOI in a week, and then 2 months later, deal close. We typically take our time, because we do apply a bunch of these metrics, and some of them are not analytical. We require people to go to the company and operating compliance, part of the compliance and operating team, and see the company and flag the things that can go wrong. And these are the things that we're learning again with each one of the acquisitions, right?
How has your view changed when it comes to customer concentration? Because there may be some of those smaller companies which maybe serve those, I don't know, 10, 15 larger clients, but these are maybe the ones which you would like to have on your portfolio serving them. So has this customer view on customer concentration changed over time, as now you have so many portfolio companies, even though if the company you would like to acquire, they might lose maybe this one or two customers, some other company from your portfolio might take over this client?
Sure. So look, part of what I think why no single acquisition has been a bad deal or blown up is because each acquisition, even if it's less, let's say 100K in EBITDA, has its own LBO with no synergies assumed. So also that is pretty conservative, and that we could have been gone faster if we assume a lot of synergies and we assume, oh, if the company is acquired in Barcelona, we already have a big structure, we're going to reduce labor, or we're going to increase cross-selling and whatnot, but we don't assume any of that. What it means is that every company, number one, must be a viable business, already profitable on its own, and be able to endure. We put obviously downside scenarios, a downside scenario, and even then it has to be accretive at the rate of return that we expect. So it means, because of that view of looking at each individual deal, a company at its own deal, it means that for us, customer concentration at the individual acquisition, it's measured at the individual acquisition, which means that we are not comfortable with certain threshold of concentration. And if the company is concentrated above that threshold, they need to put that a significant part of the acquisition price as an earnout, right? Even when you look at the aggregate now, because we are so big, probably no specific client would be not even 1% of our revenue, but we're committing capital and we're taking capital from our LPs and deploying it to acquire that customer. So even if on the aggregate, it doesn't make a difference, we are putting capital at risk and we don't feel comfortable at that. So today, not even the largest customer represents not even 1% of our revenue, and we want to keep it that way. And I don't foresee us changing our criteria and saying, look, we're going to acquire this company in which the top 3 customers represent 50% of the revenue, and we're just going to treat it as any other acquisition. And if we lose those clients, it might not be such a big deal because we're so big. I mean, if we're deploying capital, we treat that as very important and a big risk that either is managed or we don't go forward with the acquisition.
Now, I was doing the research, and you've said out that your goal is to double the EBITDA to 16 million. So what must be true across the M&A pace, integration, and the overall organization to really hit those numbers within the following years?
Yeah, as we also evolve, we're changing our targets. I would say that right now, as long as we are the best owners for this business and we continue to deploy capital the same rate of returns, and that means the things that you said, with our acquisition process, with our capital stack, like we're very conservative in the use of debt. We're very conservative because of the type of LPs that we partner with. So we take care of their capital with more care, let's say, than other institutional sources. And so it means that we could double or triple the EBITDA that we have right now if things continue as today. But how markets are. If things change in the environment, or the acquisitions become bigger, or we discover that our synergies reach a limit and our rates of return of every euro invested decreases, that's probably the end of the capital deployment phase. But so far, I mean, we just continue on that trend. We're still very small, right? When you compare pan-European players, much larger than us, or worldwide, if you take a look at Shaw, right? 7 billion in revenues, and apparently they continue to deploy capital at the same rates of return. So I don't know what is the limit, but what I can say is that so far we haven't found that out, and we are focused on execution and making sure that efficiency of capital, of using capital, is still maintained.
I don't want to ask advice from you, but maybe just a based on your experience, if you would, because we have a lot of business buyers, independent searchers listening, what would be maybe some of the, if you would have to give like a 1 hour masterclass, we're not going to do it today, but what would be the maybe 3 modules you would cover in this masterclass, super valuable for folks wanting to acquire business or building this portfolio, doing additional acquisitions? What would be your take?
Beyond the obvious of how to structure more of the corporate, let's say, finance, which many of these people going into ETA don't have, how to structure transactions, the right capital stack, how to structure your business for an exit and whatnot. But that's kind of commodity. So that's the first part, right? Like treating capital as its own science, let's say, right? The second on how to build repeatable processes and system does not necessarily mean software, right? It could be SOPs, organizations, but that is important because the operating part of at least ETA at the small scale, it's important. But I think again, that's commodity, and there's a bunch of people that are very good at providing this context. I think the third one, and really the critical for me, is that the entrepreneur finds what is a good fit for their particular skills and temperament. Right now, there is a bunch of people, the roll-up space is really hot. AI roll-ups are all over the place. And I see people that are not necessarily motivated because they believe they can add value or they will be motivated by this, but rather it seems like an easy thing to do, right? And then when you come into this, what we're doing, it's still like we have a large infrastructure, a large team. We know and learn from doing many acquisitions, but still every day, most of the things that I'm doing, it's low level issue management, right? And it can be like that for many, 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 many years. And there are different ways of deploying capital. You have the serial acquirers that are more of the holdco level, where you can be on your office doing capital allocation decisions, one decision per year, and that's a different type of thing. And some people think that buy and builds are that I'm going to be sitting, evaluating deals and making capital allocation decisions, but that's probably 2%, 3% of your time. And then the rest is fixing payroll issues, contract negotiations, labor disputes. And we're not yet on that phase where a bunch of people that want to do roll-ups are doing it, but unfortunately, I foresee a bunch of failures, not because of capabilities, but because people discover, oh shit, this is not a capital allocation job. And I think that's where people need to really understand what they're going for, and probably the most important part of this training that you mentioned.
And something you said before we started recording as well, that you are a big believer in serial acquirers, and if this journey ends for you, who knows when exactly you're going to exit? Maybe you're doing an IPO, who knows? Only you do and your team. But still, the next thing you would do would be probably a similar type of strategy. Why you are such a big believer in this model?
Yeah, sure. Look, I'm Mexican American. I am also, as I think I mentioned, an American citizen, and I'm pretty much like the way of organizing of the American economy, where it's more oriented towards big capital, maybe generates bubbles, but there's a lot of capital deployment, and then you develop new things, and then things obviously burn down, but then you start on a higher base. And that creates like all the different technological and business innovations that we know, most of them come from America. I'm in Europe now, and I'm much less optimistic, not only about the future trajectory. I don't spend time thinking of that, but about the current state of the European economy. But one thing that I see that is there are more opportunities than in America is that there's still much, much more SMEs in Europe. And the owners of those SMEs, even if it's not our thesis, they are retiring. And everybody knows that, right? Like the gray tsunami and whatnot. So it's an opportunity. And big companies in general are better at using capital and at providing services for customers, but also at providing better conditions for employees. And I think that Europe has way, way more runway for these kind of things now that's what I'm so optimistic about this, right? Now, again, I don't want to say that everybody should be doing a type of roll-up, because there are many ways of building these big businesses that don't imply getting in the weeds of things. But regardless of how the opportunities approach, I do think it's a big opportunity for many decades to come in Europe, and something exciting to be involved with.
But if you discuss this type of ideas with other folks doing the same thing, if you take maybe another industry, do you think the sweet spot is still those smaller 1 million EBITDA type of deals, that you don't go to the larger ones, because then you start competing with the funds and family offices, and those small ones is where a lot of execution happens, and being boots on the ground, you can do some great you can generate some great returns if you know what you're doing.
Well, I don't think it's the only way of doing things, by the way, right? Like, remember, I come from the software world, what is the opposite. Like, we don't take product market risk, we only take execution risk. In technology, you take product market risk, and sometimes even if you are bad at execution, if you have the right fit, you can create huge things. And there are other people that are great at taking appreciated assets, even paying a lot of money, and then turning into better assets. If I was great at manufacturing, and I could buy a 20 million EBITDA business, maybe you're great at turning that asset into a higher velocity or less, Six Sigma, whatever. And I'm sure there's somebody with those skills that right now is doing that in Europe. But I'm not, again, I'm not an economist, so I don't look into these things. I look very narrowly at my part of the world, and see that, yeah, for the people willing to do these things, it's an exciting place to be. But it doesn't mean that it's by far the only place where you can create value in the economy. It's just my corner of the economy, right?
And now, last one for you. Have you in any way maybe surprised your investors, like doing so many deals in such a short period of time, being like so good at this?
I think our investors are happy, and that's what we've done, by the way, many capital increases, and that they have supported us. But obviously, you know how human nature is, and we ourselves put a bar that is high, and every year we reset that bar. And so we don't measure ourselves, against a theoretical. Again, I haven't even looked at the statistics, but if you look more than 30 acquisition in less than 2 years and a half, probably in Europe, there's very few people that have done it without burning a single one. But we don't measure. I mean, this is not a contest, right? In the end, we have a goal, and we have some capital deployment with some threshold in returns. And that's the thing that we measure against. And on that metric, we're just meeting our own ambitious plan that, by the way, gets reset every year. Just recently, we had our 2026 planning, and it's reset at the baseline that we ended the year. So we don't have time really for cheering and and applauding ourselves, but our investors are happy in the way that they continue supporting us with more capital. But that's the point where it stops, and then we together are aggressively pursuing our targets, and that's it.
But today, if you look at this, are you more towards this permanent hold or more like build to sell?
Yeah, so I mean, that is the part where you have to respect the capital, and their own needs for liquidity, and their own needs to provide returns to their constituents, be it their family or their own set of investors. So we really have some agreements with them, and it's not on our decision to say we want to keep it or we want to sell it. It's more, again, if we are still the best owner of the business, which means that the return on capital are increasing or maintained, you put everybody in a difficult position, right? Which is, should we continue? Should we exit? That's hard. But the moment the returns start plateauing or start decreasing on incremental capital, then maybe we're not the right owner. Maybe the right owner is somebody that buys it and put 80% more leverage on it, but takes more risk, and it's not going to be us. But those decisions are very ongoing with our. So it's not about if they're happy with us or not, right? It's more whether that euro of capital, it's better putting into the company or returning to the investors. And that's a pretty mathematical decision, and not sentimental or how happy they are with us. So yeah.
Luis, it's been a lot of fun with you. Two quick fire questions. What is the best investment advice you've ever received?
I think it's the easy one, and I continue to do it. And I've been very careful with money my whole life, which is save as much as you can, and save often and compound. Is the boring answer, but it has served me effectively, and it has. I've been always entrepreneur my whole life, but just because of that I always saved and reinvested a bunch of my own money. I feel that I can take risk, and so the very simplest of advice is still the best one. Save, compound, and grow your own nest, right?
And when it comes to reading, what has been a great book you've read recently?
Oh, I'm a voracious reader. I have Audible, I have Kindle, I have books, and I'm very promiscuous in the sense that I don't finish a book if I got the core idea. Some books should be a blog post, and so I've read the last year probably more than 100 books. But in that way, I'm not good at keeping dates, name. I just get core ideas, and then if I like an idea, I look for other books. So I can tell you the one that I just finished, which is Koch Land, which is basically the story of Charles Koch and the development of the largest private company in the US, which is Koch Industries. And it gets very in the weeds of how he built a system that enabled a company that was focused, 30 million company, focused on pipeline development for oil, into a huge trading conglomerate that it is today. And the same guy leading it through different phases of changes in the economy. But that's the one that just finished today. So I could talk like that about a lot of the books that I read.
Awesome. Again, thanks, Luis, for doing this. Happy to do it 1 year from today to see where you are. But thanks a lot for your time today.
Yeah, happy to. And by the way, if people, again, want to understand more of the fit of doing things like what we're doing, happy to that they hit me up via LinkedIn. A lot of people have helped me. So I'm very open of helping people in the journey. And thanks for having me.
Sure. I'll put the link in the description as well. You can be sure.
Thank you.